Hey everyone, welcome back to another YouTube video brought to you by Frank. In today's video, we'll be going over the difference between investing and gambling. In the era of Bitcoin and online forex trading, it's easy to lose track of the difference between investing and gambling. We all know that gambling is a high-risk activity. The phrase, "it's a gamble," refers to things that are uncertain and dangerous. When we gamble or take a chance, we usually accept that the odds are against us. In other words, there's a higher chance of losing than winning. When you buy a lottery ticket, you expect to lose your money. The only reason you keep buying these tickets is that there is an outside chance, albeit very remote, that you will win big. But what does this have to do with investing? Yeah, but the share market is really just a gamble, isn't it? This is the kind of statement we hear quite often at Frank when we talk to people about investing. And this is why it's important to understand the difference between investing and gambling. How do you tell them apart? The difficulty is that so many people say so many different things. You hear about shares that went up 50% overnight or down 50% overnight. You hear that Bitcoin went down 20% in one day and then shot up 20% in another day. Some people say Bitcoin is a gamble, others say it's an investment. Some people say shares are a gamble rather than an investment. Who do you believe? We've already described one of the most prominent features of a gamble, namely, you're unlikely to win, unlikely to get anything back, and more than likely to lose the cash you put down. So what are some of the characteristics of an investment on the contrary? 1. Zero chance of losing all the money you invested. 2. A very low probability of losing money over the medium to long term. 3. A good chance of a positive return over the medium term. 4. A very high probability of a reasonable return over the long term. 5. An asset with intrinsic value that generates income and capital growth. Think about the above points in relation to property. A house might go down in value, but it will never suddenly lose all its value. Over time, in general, property prices go up, which means a positive return. Over the long term, as you pay off the bond and the transaction costs are spread over a longer period, the chances of a reasonable return increase. And finally, the house represents a tangible asset that could generate income if you were to rent it out. Shares in listed companies have similar characteristics, which is why on the whole the share market is not a gamble, especially when you buy shares in profitable companies with well-known products. When you buy shares, you become a part owner of an established business. That's very different from buying a lottery ticket. In the world of investments, we are looking for the sure thing. While there is always some risk, global stock markets have on average provided double-digit annualized returns for at least half a century, provided you stay invested. It's a bet where odds are stacked in your favor, not against you. All you need to do to win is to have the patience.